Welcome to Monday's review of the Sunday papers. So every week I get emails from clients saying, Joe, have you read this in the whatever, Sunday Times? What do you reckon to it? So I thought, would it be useful to share my thoughts on the Sunday papers, personal finance sections on LinkedIn? So this is what we're doing. So I've got 4 papers. I've got the Financial Times money section, which is my favourite personal finance paper. I've got the Sunday Times, I've got the Sunday Telegraph, and I've got the Observer to give me a nice broad range of topics to discuss. Now, I feel a bit like that bloke on Gazzetta Football Italia reviewing the papers. I'm not in a coffee shop, I'm in my little office at the end of the garden. I don't have any coffee, unfortunately, so that's where the similarities end. So what I thought I'd do is just talk you through some of the stories and then maybe give my little thoughts on it. So this is my favourite to read. If you're only going to read one, I highly recommend this, the Financial Times money section. It's a really, really broad view, and I could literally speak for an hour on the topics in here. I won't, I'll just pick out a couple. All of these papers are focusing on the big themes of the day, which are clearly inflation and the impacts on sort of personal finances. So generally speaking, it's about mortgage rates and it's about energy prices. So on that note, mortgage lenders cut 10-year fixed rates. So it's a sign that borrowers are seeking certainty on costs amid rising inflation and interest rates. Mortgage lenders are cutting interest rates on 10-year fixed rate deals while raising them on short-term fixed home loans. Very obvious point, but if you are on an SVR or a variable rate of any kind, then potentially increased costs could be worrying you. So if you're trying to price in certainty, then that's a fairly obvious point to be making. How does your bonus measure up? Bonus season this spring is expected to be one of the most generous on record. FT Money wants to know if you're expecting a bumper payout, and if so, what you intend to do with the money. Well, I'd be interested to know the results of that survey, because that's a question I get asked all the time. At the moment, we're doing all of our client reviews of portfolios and making a plan for 2022 before the end of the tax year. And every client says, I've got this to invest, or with my existing investments, what should I be doing this year? And it's a really difficult question to answer. Generally speaking, well, actually, and specifically to this period of time, we'd always encourage you to think of your investment portfolio over a very long period of time. And be globally diversified and actively rebalanced and have a focus on risk, invest it, and then try not to look at it, because what it's worth in 6 months or a year isn't particularly relevant if you don't need the money or income from the money for 20 years. It's just not relevant. So just like you don't get your house valued every Monday morning, nor should you be looking in your investment portfolio. So viewed in those terms, then potentially the short-term swings and roundabouts of market movements are just noise. So that's what we encourage our clients to do and to think about. One of the best articles in here this week, is 6 things I wish I'd known about money at 20 from a guy called Ken Okorafor, who runs something called the Humble Penny website, which I hadn't heard of before, but I've just checked it out. It looks really, really cool. So 6 tips, talks about compounding. Penny has the power, so starting with something rather than nothing. The real cost of spending money, so the opportunity cost of not starting early. The investment path you choose matters, so low fees and globally diverse and all that sort of stuff. Give yourself some space for a flutter. So if you want to have a go on crypto because all of your mates are and you're in an investment club, then feel free, as long as it's something small and that you can afford to lose it. Don't be sort of beholden to a strategy that you find limiting. And then what works today might not work tomorrow. So we probably know what markets will do and look like over the next sort of 1-3 years type thing, but extend it to 10 years or 30 years or 50 years, then there could very well be new asset classes that change the world, and so you should have an open mind. A really nice article, and his website's great, the Humble Penny. Investors can hold tight in turbulent markets. Financial education for primary school pupils is really important. I've just read a book, a couple of months ago, Grandpa's Fortune Fables by Will Roney, I think his name is. I'll link him down below. So if you've got kids then of sort of 5 years and older, that's a really good book to go into. Do I owe tax on my cryptocurrencies? And then all the usual bits and bobs at the back of the FT. Again, if you read one thing, read that. It's really, really cool. Oh, crikey, I'm nearly at 5 minutes already, 4.5 minutes. So the Sunday Times. So one of the articles in here, the price war to woo young investors, talking about sort of done for you, off the shelf, multi-asset, globally diversified, actively rebalanced, risk targeted portfolios. and we love them. We think they're really, really useful for the majority of people, depending on sort of life stage and attitude to risk and whether you want an ESG filter and all of this sort of stuff. But as an off-the-shelf product, we think they're brilliant. They're really, really fit for purpose. One of the interesting things in this article is last week Hargreaves Lansdown published its value assessment report, which analyses the performance and charge of its funds. It found 8 out of 10 of its multi-manager funds did not represent value. That's very unsurprising for us when you look at the entirety of the active management industry over a 10-year period. 8 out of 10 or 4 out of 5, if you want to simplify it, failed to outperform the benchmark, and that's a very consistent finding. So chopping cost out or controlling cost is one of the main ways that you can achieve what you need to achieve financially. Taking guesses and punts on what the market's about to do and which stock's about to outperform or which sector to be in, it is very, very hard to do persistently. Some might do it very well over a short period of time, but extend the period of time and then there's a reversion to the mean, take the costs off, and 4 out of 5 underperform. Finally, in the Sunday Times, there's an article at the back with Matt Cardle, and this is important because are you a spender or a saver? I'm a spender, pop star, who, no judgment there. If I'd had that much fun in my 20s, I'm sure I'd be a spender as well. Do you invest in shares? It's never really been on my mind to invest or build money, as I've always been so focused on my career. Now, that's something we can all get on board with. We all sort of feel that. What's been your best investment? My flat. What's better for retirement, property or pension? Definitely property. Now, I disagree. Property is a great investment, but it shouldn't be the only investment. Everyone should have a diversified strategy. Now, this is echoed in the Sunday Telegraph, where there is an interview with Mika Paris, who is a soul singer who released an album So Good in 1988. I haven't heard of her, I don't think. I may have heard some of her stuff. But there's a question to her. Bear in mind she's 52. Do you have a pension? And she answers, no, I don't believe in pensions. I just don't trust anything to do with companies that go bust. And when you see what happened in Greece, the Greek government cut state pensions over the last 2 decades to deal with this financial crisis, it scares the hell out of me. But I'm all about life insurance. Also, my pension is my music estate. I still get royalties. So there's a huge amount of confusion everywhere about pensions. And I don't think articles like that particularly help, because the readership of these papers is enormous. I think there should be some journalistic responsibility to educate and inform people that a pension is literally just a tax wrapper. So by not believing in pensions, I don't believe in bank accounts. It would be the equivalent, which it's not her fault. It's just how popular, sometimes the popular culture and people in the spotlight, if they don't understand something and they're giving their opinion on something, then they can be perpetuating myths, and that is an issue. Anyway, off my soapbox. Last paper is the Observer. There's not a huge amount relevant to sort of financial planning in this week, but they are talking about the impact of inflation on standard of living. UK inflation rate expected to be 7.25% in the spring, up from its current 5.4%. It's worse in the States. They think £180 is the amount by which the average annual grocery bill is on track to rise by this year, according to retail consultants Kantar. Talks about Meta's share price. So Facebook, Meta, Facebook lost 25+% of its value overnight last week, which was $230 billion in market value, which was easily the biggest one-day loss in history for a US company. So that speaks to the volatility of the equity markets, and certainly parts of the equity markets, which are susceptible to changes in inflation, stuff like tech stocks. And actually in the Sunday Times, there's a 77-year-old man who I assume is retired, talking about his rotation into bank stocks because he thinks that they're a better bet for inflation. I mean, use a professional, diversify your investments. You know, it's very, very difficult. 4 out of 5 active fund managers underperform the benchmark over a 10-year period, and they spend a lot of money on research and a lot of highly skilled people, and he probably isn't any of those things, I wouldn't say. I'm sorry if I've been rude to him, but using a different strategy probably will give him a better outcome. Anyway, that's nearly 10 minutes, far too long. Thanks for watching. If you like it, give it a like and share it around, and we'll see you next week. Cheers.